In the last video, we covered why safe covered calls can quietly hurt your portfolio. But here's the truth. When used correctly, they're one of the smartest income tools in options. In this video, I'll break down the only time a covered call actually makes sense and how to use it to create steady, responsible returns without capping your long-term growth. When not to use it. Before we get into the good setups, let's remind ourselves when covered calls don't work. When volatility is low, the juice isn't worth the squeeze. When your stock is tanking, you're just collecting pennies in front of a steamroller. When the market's in breakout mode, you'll sell your upside too cheap. Covered calls are about timing and context. They're not a monthly paycheck, they're a tactical tool. When they make sense. The best time to use covered calls? When the market is neutral to mildly bullish, meaning your stock is likely to stay in a range or rise slowly. Why? Because in that environment, the stock gives you slow growth. The option premium adds income. You're unlikely to get called away too early. Think of it as renting out your shares when they're not doing much. And getting paid for patience. What makes a smart covered call? A good covered call balances income and opportunity. Here's the formula pros use. Sell out of the money calls. 5 to 10% above current stock price. Target 30 to 45 days to expiration. Short enough for quick decay, long enough for premium. Sell during high IV. More volatility equals more premium for the same risk. Avoid earnings weeks. Assignment risk skyrockets. Stick to those 4 and your income starts working with your portfolio, not against it. The real goal? Yield on risk, not hope. Covered calls aren't about chasing huge returns. They're about improving risk-adjusted yield. Example, you own 100 shares at $50. Sell a 55 strike call for $2. If the stock stays below 55, you earn $200 or 4% in 30 days. If it's called away, you still keep the premium and the $5 gain on the shares. That's a 14% annualized yield with risk you already plan to take. Not bad for a boring trade. To recap, covered calls make sense when volatility is high, markets are calm, and you're comfortable owning the stock. Sell out of the money strikes, avoid earnings, and time your sales for optimal decay. Don't force them, use them strategically. When used in the right conditions, covered calls turn quiet markets into quiet profits. Thanks for joining us. If you want more setups that make real-world sense, hit like, subscribe, and comment below. What's your favorite market condition for selling covered calls?